Most investors bet the Fed will stay put, the risk stay put in 2019. So do you agree with the market's
right? No,
view?
I don't in this case. So I'm in the economist community that sees most of the underlying data as being fine. And yes, there are concerns, but the outlook I think is still consistent with further Federal Reserve rate increases. The Fed's looking at a median of 2. I think that's a very reasonable expectation. The data has been consistent with that. I think the Fed may very well take March off. May say, yes, there's been volatility in financial markets. We have some policy uncertainty at the moment. Financial conditions have tightened. Inflation's pretty modest. So maybe we can let this play out and we'll revisit the rate hike cycle in June.
After March.
After March, perhaps in the middle of the year. But yes, I think markets should expect the Fed's projections, meaning further rate hikes, to be realized.
So for this year, if people ask you about how many will the Fed go, you will probably say just 2. Just 2, or?
We have 3, so we have a modal outlook of 3, meaning if our expectation is correct, that the slowdown globally doesn't slow things down in the US all that much, and the recent volatility in financial markets stabilizes, then you're probably looking at more like a 2 to 3 hike outlook. But I think the point is 0 doesn't feel right. So to your previous question, do we agree with the market pricing on that? No, at this point. I do think you'll see more.
Yeah, yesterday, Dallas Fed President Robert Kaplan was open to the public, said that the Fed should not be taking any further action until some uncertainties resolved by themselves. But how to resolve by themselves?
Well, I think his point, and others, and Powell mentioned it again this morning, is that, and Loretta Mester, the Cleveland Fed president, mentioned it this morning, the data will just tell them from here. I think their view is we've raised rates enough such that we think we're somewhere around neutral, although we don't know exactly where that is. And from here, the data will tell us whether we have some more work to do, which I think the employment report today told them they probably do, or the data will weaken and soften in a way that tells them they've done enough already. So I think it's another way to say it is it's easier to get off of 0 and become less accommodative. It's harder to get tight, particularly when you don't know where that line is. So I think from here, it'll be a combination of how volatile are financial markets, how much uncertainty comes from the policy front, meaning trade and the domestic government shutdown, versus where growth and employment and inflation are. And my guess is right now they can still afford to be patient. That was the operative word of the day from Powell. So the data could push them into action in March, but I think for now they're probably in a wait and see mode that may take them closer to mid-year.
It's a difficult position for the Fed to be in, just because to cut the interest risk,
it
would need to admit that the economy is rolling over, which is contradictory to the Fed.
Well, and there's really no evidence in the data that it's happening, right? So there's not a lot, there's virtually no weakness in the incoming data. That would suggest a recession. Now, the caveat to that is even people like me who sound very constructive on the US economy, we're still thinking recession risk is there. It's just more in 2020, maybe 2021. So it's a fine-tuned difference between where we are and where the market is. Yes, we all expect growth to slow. We all expect recession risk to be rising. The market's just looking for that sooner. Most of the rest of us are looking for it a little bit later.